Hello everyone and welcome back to Auditor's Nonprofit Auditor Points. I'm Irina Ryshkova and I'm your nonprofit auditor. And in our last episode, we talked about fixed assets and how they should be recorded, what costs should be capitalized, what costs should be expensed, and what we consider placed in service. And we ended the episode with an important point. Fixed assets may already exist on a book before depreciation actually begins. Depreciation generally starts when the asset is placed in service and ready for its operational use. So today we're going to focus on the next major topic of the fixed assets, which is depreciation. Many people hear word depreciation and think it means market value, resale value, actual physical condition of the asset. Nothing is correct in above statements. Under general accepted accounting principle, depreciation is not really about market value at all. Depreciation is a systematic, consistent way of allocation of the cost of the fixed assets over the period that benefit from the use of that asset. And that period we call life of the asset. So depreciation, it's a cost allocation of the asset over the useful life of that asset. So depreciation, its allocation process, it's not a process of adjusting market value. Market value has nothing to do with depreciation or the cost of the asset. For example, suppose the nonprofit purchased a vehicle for its program activities. Even if the vehicle market value changes over time, depreciation under GAAP is primarily focuses on allocation of original cost. And when we're talking about cost, we're talking about how much organization paid for the asset. And that concept directly to one of the basic accounting concept under the GAAP. It's a matching cost principle, meaning that for the period when the organization benefit from use of the asset. If a nonprofit purchases equipment that helps organization operate program over many years, GAAP generally says that the costs should not be hit expenses in one single year. Instead, the organization gradually recognizes the costs, such as depreciation, over the useful life of that asset. For nonprofits, this is important because depreciation helps present a more accurate picture of the true cost of operation expenses each year. For example, donors, grantors, board members, management are not only interested in salaries, utilities, supplies, but they also need to understand what is ongoing costs of running its program. So that will include using buildings, vehicle, equipment, and other long-term assets that support overall organization mission. Otherwise, if the nonprofit will purchase vehicle in year one and expense the cost of the vehicle in year one, but will continue using vehicle for the next 5 or 6 years, then the expenses will be distorted. In year one, it will be a lot of expenses because there is a cost of vehicle, but in the future years, there are going to be no expenses. However, a nonprofit continue using that vehicle in operations. Therefore, the cost of vehicle is capitalized as an asset and gets depreciated, meaning cost allocation, equally throughout the useful life of the asset. Now, before we continue, let's just clarify a couple of very important terms. First of all, historical costs. Historical costs, or sometimes we're using just cost, it meaning original cost of the asset, typically how much the nonprofit paid for the assets. So that will include purchase price, shipping, installation, setup, and other necessary expenses that require to put that asset in operational use. That's altogether called cost or historical cost. Now, what is accumulated depreciation? Accumulated depreciation, it's a total of depreciation expenses that was recorded for that assets, start from the date when the asset was put into service. Accumulated depreciation is what accountant called contra asset account. Why contra? Because it's typically reducing the cost of the asset. Simply means it's reducing carrying value of the assets. And finally, net book value. Net book value is generally its original cost of the asset minus accumulated depreciation, and that's the net that is left to be depreciated. For example, let me give you an example. Suppose nonprofit purchased equipment for $50,000. Several years later, accumulated depreciation may total $20,000. Why? Let's just say useful life of equipment 5 years. So $50,000 cost of the equipment, meaning if we take 50,000 divided by 5 years, it will be depreciation expense $10,000 per year. After 2 years, $10,000 plus $10,000, accumulated depreciation will be $20,000. So if the cost $50,000, accumulated depreciation after year 2, $20,000, net book value will be 30. 50 minus 20 will be $30,000. Once again, net book value, it's not market value or replacement value or appraisal value. Let's use proper terminology. Cost, accumulated depreciation, net book value. It is simply accounting method based on historical cost minus accumulated depreciation. So now let's talk about major components that we used to calculate the depreciation. The first component is the asset cost. And as we discussed in the previous episode, this is the cost that we capitalized, historical cost, right? That includes purchase price and all other costs necessary to put the asset for its intended use. The second component is useful life. Useful life, again, it's very little to do with actual useful life of the assets. It's more estimated accounting useful life for the asset or for the class of the assets that nonprofit uses based on its policies and procedures. And that period will be used to depreciate the asset. For example, again, as we discussed, computers, maybe between 3 and 5 years. Furniture could be 5 to 10 years. Vehicles, 5 to 7 years. Building, 20 to 40 years. And again, useful life depends on the circumstances and may be slightly different for each organization. And two nonprofits may use similar equipments but differently, depending how the asset going to be used, environment in which the asset's going to be used, the organization policies and maintenance practices. And then the third component, maybe that you are familiar with, it's a salvage value. I have to be truthful with you and say that in small nonprofit organization, we do not see salvage value used often because typically small nonprofits trying to use the asset completely and fully until it completely has no value. However, if we're gonna talk about terminology used for fixed assets. Salvage value, it's a very important component. And salvage value means the estimated value of the asset that will be remaining at the end of the useful life of the asset, meaning when you can sell it for scraps, like when their organization absolutely cannot use the asset, but it still has some value. So that value, it's never depreciated, because after a useful life is completely used, the asset provides no benefit for the organization, but it still can be sold at some value. So again, as I mentioned, in practice, many nonprofit has very small salvage value, or it's a zero, because estimated residual value may be very small and immaterial. But if there is such value exists, that value never gets depreciated, because regardless, at the end of the life, that asset can be sold for that much. Now let's move to the most common depreciation method. It's a straight line method. Most nonprofits use straight line method for financial statement purposes. It's a simple, consistent, and generally aligned with nonprofits' use of the asset. Typically, if we use vehicle, it's the same benefit throughout the useful life. We don't get more benefit in the beginning of the life of the asset unless later. If you use a building, typically, again, it's the same benefit. Therefore, we're depreciating equally, in the equal amounts throughout the useful life of the asset. So under the straight line method, the same amount of depreciation expense is generally recorded each year over the useful life of the asset. So conceptually, the calculation of the depreciation looks like this. You take asset cost minus salvage value, and as we indicated before, typically in small nonprofit, salvage value is immaterial or zero, so we can ignore it. And we're taking the cost of the asset and we divide by useful life. And that would be depreciation expense recorded annually. For example, suppose a nonprofit purchases a van for $60,000 and expects it to live for 5 years based on the policy. Ignoring salvage value for simplicity, again, it means that nonprofit will take $60,000 of the cost of the asset, divided by 5, it gives $12,000 per year of depreciation expense that needs to be recorded over the next 5 years of the useful life of the vehicle, starting when the nonprofit gonna put the vehicle into operational use. So sometimes each year or sometimes monthly, depends how the organization records. It needs to record the journal entry, debit depreciation expense, credit accumulated depreciation for $12,000 if it's annually. Depreciation expense will be recorded when we're debiting depreciation. It will be recorded part of your income statement or statement of activities as expense, but accumulated depreciation will go on the balance sheet, and it's called contra asset account. So we'll see cost of the asset, $60,000, and right below it, we're gonna see accumulated depreciation, $12,000, but it's gonna be negative. So that's why it's a contra. So we'll see positive number, 60,000 cost, and accumulated depreciation, negative number is $12,000. So next year, if we depreciate year 2, it's again going to be $12,000, debit depreciation expense, credit accumulated depreciation, and again in the year 2, income statement or statement of activities will show the same depreciation, $12,000, but accumulated depreciation will be now $24,000. So balance sheet will show cost of the vehicle, $60,000, and accumulated depreciation now negative $24,000. So again, in year 3, again it will be cost $60,000 and accumulated depreciation $36,000, and so forth until in the year 5 we will see cost $60,000 and accumulated depreciation $60,000. You will see it's the same amount. It's called asset is fully depreciated, but we will keep it on the books as long as the asset continues to be live and used in operation activity. But net will be zero. However, we do keep it at cost and accumulated depreciation. Now, I want to talk about very important point that there are some assets that are not depreciated at all. And this is land. Land is considered fixed assets that has no useful life. It means that land lives forever, and we do not record depreciation expense on the land at all. Because again, it's considered to have indefinite useful life. However, land improvements are different. So for example, if nonprofit has a land, but it has like a parking lots, fencing on the land, certain landscaping improvements, outdoor lighting system, those are depreciating because they do have a wear and tear and they considered land improvements. We do depreciate land improvements, but the land itself, it's not depreciable. Now, I want to talk about some common depreciation mistakes that we as auditors often see. One common problem, organization capitalizing fixed assets, but never record depreciation at all. So we receive books and we look at the balance sheet and we see accumulated depreciation this year and accumulated depreciation last year exactly the same. It means that no depreciation was recorded. It means that expenses are understated if we forgot to record depreciation, and net assets are overstated, and overall financial statements may not properly reflect ongoing cost of operations. Another common issue, we see depreciation of land. Or sometimes we see the organization use unrealistic useful lives. For example, extremely short useful lives or extremely long useful life or just inappropriate useful life. And finally, another timing happens when the organization start depreciation. Sometimes they start too early, sometimes too late. It needs to start when the assets put into service. And as we discussed in the previous episodes, depreciation needs to be attached to the asset, and as soon as it starts operational, we need to start depreciating it. Okay, before we finish today's episode, let's just summarize what we talked about. First of all, under GAAP, depreciation is a process of allocating of the fixed asset over the period for which it will benefit nonprofit by using that asset. It's not a market value. We're not market to value. We're just allocating the cost. And depreciation is typically depends on the assets, capitalized cost, useful life, salvage value, which is typically immaterial or zero, and depreciation method selected by the organization, which is often straight line because it's a simple and consistent. Okay, so in the next episode, we're going to move from depreciation to another major practice area, which is fixed assets inventory and disposal. And we will talk about maintaining fixed asset schedule, maintaining physical verification of the asset existence, missing assets, disposals, and how organization records gain or losses when fixed assets are sold, scrapped, donated, or removed from service. Thank you so much. I hope you will find this information useful. Thank you for being here today, and be safe.